All right, let's get into it. Today, we're diving into a source that tries to make sense of something really weird happening in the financial markets right now. Seriously, on the surface, it just makes no sense. So here's the big question, the puzzle at the heart of all this. Why are the things people buy when they're scared and the things they buy when they're feeling optimistic, both shooting for the moon at the same time? I mean, it's a paradox, and it has a lot of smart people just scratching their heads. And this really just spells it out, doesn't it? I mean, look at this. On one side, you've got gold, the ultimate run for the hills asset, up an incredible 62% this year. That screams fear, right? But then on the other side, you have US stocks, a huge bet on future growth, also up over 10%. That signals confidence. These two are supposed to work like a seesaw. When one's up, the other's down. So what in the world is going on? You know, the source we're digging into doesn't mince words. It has this quote that just lays it on the line. These two things can happen at the same time, but they cannot be true at the same time. The author's point is that the market can't be both terrified and totally euphoric. One of these trends has to be, as they put it, an enormous lie. So, okay, let's figure out what that might be. All right, so how do we even begin to solve this puzzle? Well, the source says we're looking in the wrong place if we think it's just about fear versus greed. The real answer, it argues, is a deliberate global economic play it calls the devaluation strategy. And at the very heart of this strategy is something we all know: inflation. But this analysis asks you to think about it differently. It's not just about prices going up at the grocery store. The source frames it as a really powerful tool, a tool for the world's biggest debtor, that's the United States, to, and I'm quoting here, stiff its creditors. Basically, to pay back its massive loans with money that's worth less and less. Okay, to really get this, let's use an analogy from the source. Just imagine you borrowed $1 million 30 years ago. Think about what $1 million could buy back then. A huge amount of stuff, right? Maybe a mansion that's worth 10 times that today. That money was incredibly valuable. Okay, now fast forward to today, you pay back that same $1 million loan. But today's $1 million, it buys just a tiny fraction of what it used to. See what happened? You repaid a super valuable old loan with cheap, devalued new money. The source argues this is exactly what's happening on a global scale. In fact, it claims this is how the US has effectively wiped out 90% of its debt to the rest of the world. But it goes even deeper. The source lays out this really provocative three-step process it calls the sheep sharing of bondholders. Here's how it supposedly works. First, the US sells its bonds to the rest of the world when prices are nice and high. Then, step two, the Fed makes moves that crash the bond market, causing all those global investors to panic and sell at a massive loss. And then, here's the kicker, step three, the Fed swoops in and buys those exact same bonds back for pennies on the dollar. It's described as a massive transfer of wealth.
So, the whole point here is about flipping the script. The source claims that what everyone is calling the U.S. bond crisis isn't really a crisis for the U.S. at all. Nope. The real pain, the real crisis is for the creditors, all the other countries and investors who lent America money in the first place.
Okay, so how does all this global strategy stuff solve our original paradox about gold and stocks? Well, if everyone's trying to get away from a sinking dollar, where do they run? The source says they're taking two very different escape routes, and they're being taken by two very different groups of people. And this is really the key to the whole thing. It's not one big, unified market driving everything up. It's two totally separate groups buying things for completely different reasons. You've got the big players, the central banks, on one side, and then you've got everyday investors, people like you and me, on the other. So let's look at escape route number one. This is the central banks of the world. According to the source, they're sitting on these giant piles of US bonds that are just bleeding value. So to protect their nation's wealth from this dollar decline, what do? They run to the oldest, most trusted safe haven in history, gold. And they're not just dipping a toe in, their gold purchases have actually doubled. All right, now for escape route number two. This is the retail investors, regular people. They look at their savings accounts and just see that cash getting eaten alive by inflation. So what's their move? To keep from falling behind, they're pumping money into the stock market, hoping to get returns that can beat the rising cost of, well, everything. So that explains the why behind the paradox. Now, let's look at what the source thinks is coming next by focusing on this historic tug-of-war between gold and the US dollar. And really, the best way to think about this relationship is like a seesaw. It's a simple but incredibly powerful dynamic. When the US dollar gets weak and starts to lose value, gold gets strong.
And when the dollar is flexing its muscles and is strong, gold tends to be weak. They are almost always on opposite ends of that seesaw.
And you don't have to take my word for it, just look at history. The source points out that every single major bull run for gold in the last half century has happened when the dollar's dominance was being challenged. I mean, think about it. Back in '71, when the US broke the link to gold, in the late '70s with the Soviet rivalry, in the '80s with the rise of Japan's yen, in 2000 with the creation of the euro. Each time gold surged. And that brings us right up to today, to the current cycle. And this leads to a really crucial shift in thinking. The question we should be asking isn't, has gold gone up too much? According to this source, the real question is about the other side of that seesaw. Has the US dollar finished falling yet? So when does all this end? Well, the source gives us a pretty clear three-point checklist. For this big gold rally to finally run out of steam, three big things need to happen. 1. The US has to get serious about killing inflation. No more rate cuts, no more money printing. 2. The dollar's exchange rate has to actually stop falling. And 3. Global investors have to start trusting and buying long-term US debt again. The source argues that until all three of those boxes are checked, this trend is going to keep on going. Okay, so what does all this high-level global economic chess mean for the average person, for you and me? The source boils it all down to one very clear and honestly pretty stark mandate. And here it is, the big takeaway. In an environment that is, by design, making cash worth less over time, sitting on the sidelines isn't a safe bet. According to this author, it's a guaranteed way to lose. The argument is that investing has changed. It's no longer just a way to get ahead. It's now the only way to keep from falling behind. Which brings us to our final thought to chew on. You have this massive seesaw in motion, the dollar on one side, gold and other assets on the other. This analysis lays out a really compelling case for why things are happening the way they are. But the billion-dollar question, or maybe trillion-dollar question, remains. How much longer can this seesaw keep tilting?